Well, greetings, my beloved clients and friends. I know it's been a while since we talked. It's been a very interesting market environment. And so I kind of said what I wanted to say, so I didn't have a lot to say. But recently I had some interesting conversations with some clients that had some questions that I think maybe more than one person would have. So I wanted to share that with you all. And so just to touch real quickly on market conditions, market environment, rates have started coming down around the end of last year, around November. So rates started coming down. Powell kind of announced that he anticipated the next move would be down, and the market really rallied. And for some reason they interpreted that to mean at one point 6 rate cuts, and I think they got a little overzealous. They drove up the stock market maybe more than was justified, and now as the data comes out, they're kind of cooling their heels to, like, maybe 6 rate cuts was a bit optimistic, which is not rare for the stock market. They're always eternally optimistic, and sometimes too much, so they get a little ahead of themselves, and the market needs to settle back in before its next trajectory up. So in general, though, the trend, I believe, is from interest rates rising to interest rates coming back down. So that's a very good, strong tailwind for the market. Obviously not every day, but the general trend is that something good. And then on the negative side, we have, we're in an election year. We have crisis in the Middle East, and really kind of 3 wars going on. And but that's stuff that we've always had. It's concerning, and yet it's stuff that we've always had. We've always had election cycles every 4 years. I mean, conflict in the Middle East has been a reality since biblical times, but here's another truism, if you will. Good companies that generate a lot of cash are good long-term investments, so and they have been through good times and bad. Those companies that have proven to be able to generate good, strong cash flow in good times and bad tend to be good long-term investments, and that's the one we want to focus on. And our success has been by focusing on that. And I could even say some of the mistakes that we have made have been from getting distracted from that, worrying too much about current events or taxes or election cycles or short-term geopolitical risk. Often has led us to make some mistakes, and so I think it's healthy for me to do these videos so I remind myself and all of us, what's the proven strategy. Now, has it been, looking at these great companies that are generating strong cash in good times and bad, has that always been the best strategy over every period, on every given day, any given month, any given quarter, or even any given year? No, it's not been the number one strategy over every period of time. But over long periods of time, it's been a consistently winning strategy. Okay, so we acknowledge that sometimes we're going to get outperformed by, whatever may be the strategy du jour. But over time, our strategy has been consistent. Okay, so that was just a little preamble. What I really want to get into is my client's question, which was, what do you think about this company called AGNC, which is a mortgage REIT? And what caught my client's eye was that it paid a 15% dividend. And he's like, why wouldn't we buy this that's paying a 15% dividend? And I had never heard of the company. So I really didn't have an answer. So I looked into it and just tell you a little bit about the company. So there's a 50-person team out of Bethesda, Maryland that trades agency mortgage-backed securities, which are residential loans. The ones that are through an agency, like FHA. Okay. And they started in 2008, and they had a pretty good run from 2008 to 2012, over a decade ago. I think they came out at $15 a share. They went up to about $34 a share. But since then, over the last decade plus, their stock prices steadily deteriorated from 35 down to 9. So it's like a 75% deterioration in stock price over that decade plus. And they've consistently issued stock. So they're consistently diluting the existing stockholders, and they've more than doubled their outstanding stock count. So, that's not really good. And they've consistently lowered their dividend. Right now it's 12 cents per share monthly, which gives it that interesting 15% yield. But in the last 15 years, they've only lowered that dividend. So it seems likely to me that number one, or there seems like to be a high probability that stock price is going to continue to deteriorate over time, number one. Number two, that the share count is going to continue to go up over time, which dilutes existing shareholders. And number three, that dividend is going to be cut. Those seem to be likely scenarios. So when you look at that 15% dividend yield, that seems like the best case scenario. If they don't dilute the stock, if the stock doesn't continue to go down like it has been, and if they don't lower the dividend, right? That's the best case scenario. You might continue to get that 15% dividend, but to me that seems highly unlikely. And if you look a little bit deeper, and you ask yourself, how are they able to pay a 15% dividend? And what they buy is agency mortgage backs. So agency mortgage backs aren't paying 15%. If you go out to buy a house, you're not getting a 15% mortgage, right? And they've had this portfolio for a while, so they do trade it pretty actively. So, what could be their yield on those loans? 4, 5, 6%. That's been the environment for the last decade plus in agency mortgage backs. So how could they pay a 15% yield on assets that are maybe getting 6%? They have to be very highly leveraged, right? And they have to have positive leverage, meaning they're borrowing for less than they're paying. So then they would get a spread. And so in the last decade, really from the last financial crisis of 2009, when Bernanke came in and initiated quantitative easing, through COVID, when Powell initiated QE2, right? Interest rates have been extremely low. So that means companies like this could borrow at very, very good rates. And if they're using leverage, it was a normal shaped yield curve, and they could borrow really low to buy these loans that hopefully are paying more and have a positive spread and pay out a dividend. That's the operating environment that suits them well. And in that environment, their share price deteriorated. They issued more stock and they cut their dividend. So in a good environment, they were doing these things that are not helpful to investors. And now, since 22, when Powell raised rates 11 times on the short end and inverted the yield curve, that's a less attractive environment for a mortgage REIT to operate in, because they borrow short-term money, they lend long-term money on typically 30-year mortgages. And in a normal environment, the rate on 30-year debt is higher than the rate on 1-year debt or whatever. So they could generally get a positive spread from a normal shaped yield curve. But now they're operating an inverted yield curve, which makes their business even harder. So it doesn't seem like they did a good job in a favorable environment, and now they're entering in a less favorable environment, right? And then the structure of a REIT is that they have to pay out, to maintain a REIT status, they have to pay out, I believe it's 90% of their income. So they fundamentally can't grow the business, right? Because the way companies grow businesses, they have retained earnings and they invest them back into the company. They buy more assets, they pay down their debt, or they expand their business in some way with that positive free cash flow. Well, this company has to pay out all their cash flow, so they fundamentally can't grow the business unless they issue more stock, right? Or they, borrow more money. So on their books, they have 70 billion in assets and 60 billion in debt. So they're highly leveraged. About 50 billion is loans. Then they have some money markets. So the money markets are actually now paying about 5%. So if their money markets are paying 5%, how could they pay you 15? They have to borrow cheaper than that and have a spread. So theoretically, if they operate on a 1% positive spread, they have to be 15x leverage to get 15%. That's very highly leveraged and very risky, especially in an inverted yield curve environment. And so currently, it's showing that their cost of capital is higher than their return on capital. So, nothing looks good about this company besides that 15% dividend. And the likelihood of them maintaining that 15% dividend yield is very low. And you say, well, could it be that things are so bad that they're trading at a huge discount to book value? And that might make sense. That, based on their book value, they're trading at, they're making a 5% dividend, but it's trading at 30 cents on the dollar. So it's a 15% yield. But I looked at that too, and they're trading at 1x book value. So it's not that you're buying it super cheap. It's trading at book value. So, it's kind of like the problem that commercial banks are in is their loan portfolio doesn't align with their deposit portfolio. But they're diversified. That's a big problem, but they have diversified streams of income. This company is a one-trick pony. They only do mortgage backs. So if you're worried about regional commercial banks, you should be even more really worried about this company. So there's not a lot to like about this company, in my opinion, besides that 15% dividend. It seems like that's the best case scenario, plus 15 in a perfect environment that they're not in. The likelihood of getting less than 15 or negative returns are pretty high, and the history is that you have been getting negative returns. In the last 12 years, the stock lost about $25 per share, from 35 down to 9, and it paid out about $20 in dividends. So that stock price depreciation didn't cover, the dividend income didn't offset the stock price depreciation. That's been the case over the last 5 years. There have been periods where, you know, the stock price depreciation wasn't as much as the dividend yield. So you had some net positive return. But so it's possible for a short period of time you could have a net positive return. And technically it's possible that you could continue to get that 15, but I just don't think it's likely. I think the risk is too high for the limited reward. So yeah, that's kind of how we look at it, and that's something we'd probably stay away from in favor of companies that make money and make a product and generate profits and are able to reinvest that and continue to grow their business over time. All right, so just a look behind the curtains about stuff we look at. Hopefully that was helpful, and hope you have a great day.